Hi, welcome to a new video where today we're going to be covering the chapter Business Finance Sources and Needs, which is chapter number 21. So let's start off by looking at the finance department. A finance department in a business engages in trying to record all the financial transactions. So financial transactions include when you're having an invoice or when you're purchasing an item for a supplier, or when you trade in others, when you pay electricity bills and etc. expenses. They also try to prepare final accounts, which is a requirement for companies, and sometimes it's created for its owners or other users. You also try to gather accounting information. This could be managerial or financial information for decision making. Similarly, finance department tries to forecast cash flows in order to predict the need for future cash. So forecasting cash flows also include when you're trying to plan for a purchase of future fixed asset, which might be very expensive. So you need to plan for how you're going to arrange the money needed for buying that asset. Similarly, your finance department tries to help set strategy in terms of how to prepare for certain measures, certain deficits in the future, how to pay off certain creditors, suppliers, or how to pay for certain commitments in the future. Also, you have to understand that the finance department tries to communicate with other departments such as the marketing department when they're trying to set a marketing budget. So it's like the head of all the things that require money, and they try to provide this information to all the other departments such as operations. So operations may need to ask the finance department regarding how much raw materials they can purchase, etc. So let's look at why a business may need finance. The first and foremost reason for a business requiring finance is when it starts up at the initial stage. This is called startup capital when you try to invest in fixed assets and other necessary current assets before trading. So think about when you're trying to run a sandwich shop. The first things you'd do is maybe you'd invest in premises. So you may either rent or you may buy the premises if you're looking for a long-term solution. You would also try to get some basic ingredients such as bread and other necessary requirements, ingredients such as chairs, tables, cookware, etc. So all these things that you buy to start your trading is called startup capital. So let's look at the second reason. So as a business continues its life cycle, it goes through the survival stage, and then it tries to plans for expanding its operations because you want to generate additional profits. However, for expansion, you need to buy new assets, which requires finance. Third reason could be for increasing working capital. This means that you should have more flexibility. You have more muscles to pay for day-to-day expenses. Now let's look at the different kind of expenditure that you need to pay for. Namely, capital expenditure. This is where you pay for fixed assets or assets that last more than 1 year. And the second type of expenditure is the revenue expenditure. So revenue expenditure is any kind of expenditure that you pay for, which is not capital expenditure, and also for those expenditure that is on a day-to-day basis. So let's look at sources of finance. Now, when you think about how you're going to find the money or how you're going to arrange the finance for your business, you have to think about whether you're going to arrange it from within yourself, within your organization, or whether you're going to arrange it from external sources. You also have to think about the length of finance. So are you looking for a short-term source or are you looking for a long-term source of finance? So let's look at the internal sources of finance. The first and foremost source of finance is your retained profit. This is all the money that you've accumulated over the years through your business activity. So when you make a profit, you have some stored in your bank or other places. The best thing about retained profit is you have no interest to pay on because it is yours. And think about in comparison to a bank loan, this is your own money, so you have no interest to pay, and there is no date for anyone trying to, require payment back. Because with a bank loan, you have interest to pay, and they have a fixed date that you have to repay them. Similarly, retained profit. However, retained profit is also a limited source because there's only so much that you can gather from profitability once you pay for expenses and once you pay for other things like returns to owners. You also, when you're trying to reinvest in the business from your profits, it restricts the owners from receiving anything. So think about a company that's trying to grow in the future, and they generate profits, but they do not want to give it out as dividends. So this makes it very less appealing because as a shareholder, you feel like you're not receiving anything for your investment. The other form of internal finance is where you sell off your existing assets. So this is where you try to sell off assets that you think that you do not really need, or you think that you could replace them or replace them with something that is just as efficient but less expensive. So this means that the money that was tied up with the asset is put to better use. The best thing about it also is you do not increase your debt. So because you're financing it from your own self, there's no form of external debt where you have to pay off someone in the future. However, it takes time to sell assets and the amount raised is restricted. So think about if you're trying to sell your own car. So the amount that you get from your asset that you sell may be restricted because you have only so many assets to sell. Similarly, you have to understand that you must have excess assets. So if you have limited assets, then you do not have this option. When you only have assets that could be put to better use, you free up that money by selling them off. So let's look at other ways you can raise finance internally. So you try to reduce your working capital. What does this mean? It means that you hold lesser inventory. You try to receive your money from your debtors more quickly, and you try to pay your creditors by as late as possible. So the benefits involve that because you're having less money tied up in stocks and debtors, you have reduced opportunity costs by trying to put those free cash flow into better use. However, the disadvantages include when you're holding very low levels of inventory, there might be a slight chance of you running out of stock, which could put you in a very damaging situation where customers do not receive their product and thus your brand image gets affected. The last thing you have to consider is your owner's personal funds. So this is where the owner tries to bring his own assets and tries to invest them into the business. So this could be by you taking a mortgage on your house and trying to invest into your business. So the benefits include it's available on need. So you as an owner, it depends on when you decide to bring in your own strength. And there is no interest on payment required because normally owners do not want to be paid when they're investing into their own business. However, it's a very risky strategy because you may lose all your personal assets in the business or whatever you're investing, and your savings may be very limited compared to what your ambitions are. So there's only so much you can contribute from yourself. So let's start looking at external sources of finance. So when you think about issues of shares, you have to only think about companies that can do it, especially public limited companies where they can sell to the general public. So this is a permanent source of finance that does not require repayment. So once shares are issued, that's done. It's forever. However, for every share that you issue, you have to pay a portion of dividends as a repayment for investing. Also, you may lose control over a majority of the company as you sell more shares to others. The next source could be bank loans. bank loans usually are very feasible to arrange. So when you take long-term bank loans, you have low interest rates, and you can pay them through a plan. So you can pay them every 6 months or every year, or every 5 years. However, banks usually require a collateral, where they require an asset that could be sold in terms of if they face the risk of you not paying them for their if they face a risk of non-payment. And they could charge high interest rates for those businesses that are deemed small and risky. So when your business size is small, you're more risky of not paying them. So this means that they will charge you a higher interest rate. Other sources of external finance includes debentures. Debentures are long-term certificates that are issued from the company, and it requires payment with interest. Because of that, it makes it seem very attractive to customers. So you normally try to issue your debentures with an interest rate that is higher than that is provided by banks or other kind of institutions where your customers could invest their money in. The other source could be debt factoring. So debt factoring includes you trying to sell off your debts to an external agency or external organization, and they pay you immediately in cash a certain portion of the total debt. So they'll pay you either 95% or 90% of the total debt. So the risks of bad debt are transferred to the specialist organization. However, you will not receive the total amount of debt that you could have potentially received in the future. So because you're selling your debts for 90%, the 10% is lost. The other things include grants and subsidies. So the governments usually provide grants and subsidies to businesses that they want to influence and encourage. So they could provide it to businesses when they relocate to an area they favor, or they could provide grants and subsidies to businesses such as the green business or those that are environmentally friendly. So grants and subsidies usually do not have to be repaid, but they come with strings attached. So governments usually provide conditions that need to be adapted by the business in order to receive further grants and subsidies. So let's look at short-term sources of finance. So when you think about short-term sources of finance, short-term finance is used to pay for day-to-day expenses. So you could use overdrafts, which are overdraft is basically when your bank balance goes beyond what you have. So you go into negative territory, but it's very flexible, and you pay expenses that need urgent attention. It can be cheaper than arranging for a loan, because sometimes there is lots of paperwork when it comes to loan or other sorts of financing. But overdraft includes very high rates of interest rates, and a bank can ask for repayment at any time. So let's look at the other one, where you have trade credit. Trade credit includes interest-free loans, where banks provide you with trade credit is where you pay off your suppliers at a later date than they are supposed to receive their money. So because of this, when you try to pay your suppliers early, you could receive an early settlement discount, which is lost. And as you delay payments with your suppliers, you're kind of going back on your word. So this could affect your relations when you're trying to pay them as late as possible. And remember, when you have certain business processes, such as just-in-time, where supplier relations are very important, this is not a realistic option. So let's look at long-term sources of finance. When you think about long-term sources of finance, we've already talked about bank loans, where you take out a loan from the bank and usually you pay a small amount of interest. You also have issue of shares, which are provided by companies. So the other sources include a hire purchase. So hire purchase is where a business buys a fixed asset over a long-term payment plan. So because the asset is very expensive, the business that is selling the asset knows that realistically most customers would not be able to finance it at the spot. So you cannot pay a lump sum upfront, but you would be able to pay it over the years. So think about aircrafts. Most businesses may purchase it over a 10-year plan or a 5-year plan. Similarly with cars and sometimes with fixed assets like houses. So, however, you require an initial large cash deposit just to make sure that you have your interest, both parties have a mutual interest guarded. You also know that if you paid for the amount up front, it would cost you lesser than what you have to pay in installments, which include interest rates, which are usually very high. The second form is leasing, where you are allowed to use an asset over a long-term period through monthly payments. So this is like renting an asset, but renting it over almost the lifetime of its use. So you could lease an airplane for around 10-15 years or more. So this allows a firm to make use of the asset the same way it would have done if it purchased it, but in this case, it does not have to make that upfront payment, a large lump sum upfront payment, but rather it can pay in monthly installments. You could also deal with where in a situation where you sell your fixed asset and you try to lease it back. So you sell your building, or you sell your aircraft, you sell your other fixed asset, and then you lease it back. So in that sense, you are able to use the asset the same way that you had it when you purchased it, when it was yours, in the same way when you lease it back. But you generally tend to get a large lump sum when you sell it. So the total cost of leasing is generally higher than the purchase cost. Of course, when you're paying a monthly installments, they usually include a bonus added on. So let's look at factors that influence source of finance. So when you're trying to decide on your finance, you think about, first of all, your purpose and time period. So you think about whether you're trying to invest in long-term activities or short-term. If you're trying to invest on fixed assets that will last usually over a long period of time, more than a year, you try to match this with long-term sources of finance. You also think about amount needed. So are you trying to pay for day-to-day expenses, or are you trying to pay on a large scale? So think about if you had some $50 that you owed to one of your customers or to one of your suppliers. So would you take out a bank loan to pay that $50? Obviously not. You would use an overdraft facility. Similarly, when you think about large-scale financing, you would not use overdraft because it has very high interest rates. You also need to understand that it depends on what type of organization you are. So small businesses have to pay more in interest rates when it comes to bank loans, and they do not have the option of issuing shares. However, companies have more options, including issuing shares to either to the general public in terms of public limited companies, or when you're a private limited company, you take the consent of your families and friends and you can sell it to those that are approved of by the other shareholders. So when you consider about financing, you have to consider whether you lose control over the business. So when you're issuing shares, sometimes because you're issuing shares, you might lose your controlling majority. So is that a real factor over you? Because some people would, when they're trying to get investors on board, they have to sell a portion of their business to the investor. So is it worth for you to receive that finance to achieve your ambition over losing control? So you have to weigh up one with the other. The last thing including is risk and gearing. So gearing is when you take on loan in terms of your assets. So you try to measure your total long-term loans against your total assets that you have in the business. So normally it's considered that you can pay off your loans if you have enough assets. So remember when banks take collateral on security on fixed assets. So this is like a measure of how risky your business is. Some businesses are highly geared naturally because they can exist that way, and other businesses, they cannot gear themselves too highly, or they're seen as a risk by investors. So let's look at bank loans. When a bank tries to provide a loan to a customer, they try to investigate the customer as much as possible to make sure that they receive their payment. So what you have to present is banks go through your cash flow forecast, which tries to understand the purpose and aim of your loan. They want us to know if it's a realistic for a realistic cause. They also try to go through your income statement to understand your performance of the business, whether the business is doing well. And they want to check your existing sources of finance, whether you have other long-term loan commitments or other payments that are coming up due, which might affect your payment of the loan. They also try to identify assets that they could secure their loans on in case you fail to repay them. And they try to find a business plan that will explain to them how they're going to make use of the loan and how they're going to be repaid in the future. So let's look at shareholders' expectations. So shareholders, when they invest in a company, they seek two types of return. They either seek capital growth, meaning they want the share price of their share to increase over the years, or they want to receive higher dividends. Dividends being a portion of the profit that is repaid to them, distributed to them. So they want dividend growth over the years, or they want capital growth over the years, or they want a combination of both. So companies usually have to compete with others in their industries, and because their performance is usually measured against others, and shareholders are generally open to information of your company and competitors' company because everyone has to publish their financial accounts. Similarly, companies that have a good reputation and projected for growth. So sometimes shareholders are willing to let companies not provide them with dividends, rather make use of the profits to reinvest in the business if they know and if they can identify that the company is growing in reputation and is projected for future success.